Okay, let's get right into it. There is a massive, and I mean massive, shift happening just beneath the surface of global finance. It's this quiet retreat, a multi-trillion-dollar pivot away from all the flashy, glamorous stuff and into the things that are, well, essential. And it all starts with one of the biggest investment funds on the planet. This is a huge warning shot for investors everywhere, so you're going to want to pay attention. We're talking about a fundamental change in how sovereign capital views the world, and this is a critical update for anyone trying to figure out today's markets.
This quote really just nails it, right? This whole thing isn't just about some controversial golf league running out of cash. No way. It's a signal flare. The analysis is super clear on this. This move is the canary in the coal mine for a whole class of investments. You know the ones, those high-flying, headline-grabbing projects that were just fueled by a fire hose of sovereign money. That era, the era of the unconstrained checkbook for these so-called vanity assets, it's officially over.
So, to really get a handle on just how big this pivot is, we're going to break it down. First up, let's look at the symptoms. I'm talking about the high-profile billion-dollar examples that show this retreat happening in real time. For years, the story was simple. There was an unconstrained checkbook. If you had a project that could boost a country's image, or what they call soft power, think sports leagues, futuristic cities, fancy luxury brands, it felt like there was just unlimited money available. We call these vanity assets. They're way more about projecting influence and prestige than they are about making a quick, cold, hard cash return. Well, that whole era is now facing a very, very harsh reality check.
Okay, let's start with the most public flameout. Live Golf. As of late 2024, that league had racked up just staggering losses of over 940 million euros. And get this, their annual operating burn was almost 376 million euros. That is the literal definition of just setting money on fire, and it's symptom number one of this big pivot. And if you think the golf money is mind-blowing, hold on. Let's look at Neom, that utopian city project. The estimated final price tag has ballooned to an almost unbelievable 8.27 trillion euros, with a timeline that stretches all the way to 2080. Just the first phase is priced at 348 billion euros. I mean, numbers this huge aren't just line items on a spreadsheet. They force you to completely rethink your entire strategy. It's not sustainable. So you have to be asking, why the sudden caution? What changed? Well, this number right here, this tells the story behind the story. In late 2024, the Saudi Public Investment Fund's cash reserves plunged to $15 billion. That's a low they haven't seen since 2020. At the exact same time, construction contracts in the kingdom dropped by 60% year over year. The financial pressure isn't some abstract idea anymore. It is very, very real. So what does this pivot actually look like on the ground? This slide lays it out perfectly. It's old money versus new money. The old strategy was all about those vanity or soft power assets. The new strategy? It's a hard pivot towards real, tangible, strategic infrastructure. We're talking about things like AI data centers, industrial resilience, and what you could really call hard power. These are the assets that are absolutely critical for national security and economic independence in the 21st century.
All right, we've seen the symptoms. Now it's time for the diagnosis. What are the pressures, both external and internal, that are forcing this dramatic pivot to reality? First things first, let's be super clear about what this isn't. This is not some panicked fire sale where they're desperately trying to sell everything off. No, the term being used is quiet throttling. This is a deliberate, calculated rebalancing of their portfolio. It's a strategic slowing down of how much money they're putting out there, not a desperate dash for the exits. Think of it like they're turning down the flow from a massive fire hose, not yanking the plug out of the wall. So, what's causing this quiet throttling? Well, it's basically a perfect storm of pressure from two sides. On the geopolitical front, you've got conflict and blockades in the Strait of Hormuz, which have sent war risk insurance premiums for shipping up by an incredible 5,000%. Then on the financial side, Brent crude oil prices are forecast to be lower, cash reserves are shrinking, and like we just saw, new construction has completely fallen off a cliff. It's a classic pincer movement of risk and reality. And the fallout from all this turmoil is profound. This quote really captures it perfectly. For the longest time, there was this belief that the Gulf region was this permanently safe harbor for capital and for talent. That's over. Analysts don't see this as a temporary little hiccup. They see it as a permanent structural repricing of risk for the entire region. That's a huge deal.
Okay, so if the money is flowing out of vanity assets, where is it going? That brings us to the new strategy. And the answer, funny enough, is a commodity that a lot of people are now calling the new oil: compute power. Now, there is this huge myth out there that AI is just, a weightless digital thing that lives in the cloud. But the reality, as this slide says, is that AI is fundamentally a business of atoms. It completely depends on a massive physical build-out, and it's constrained by very real-world things like energy, water, and land. This isn't just a software update, folks. It's a full-blown industrial revolution. So what does this business of atoms actually look like? Well, experts call it a three-tier AI stock. Think of it this way. Tier 1 is the cloud. That's where you do the heavy lifting, where you train the AI. It's like teaching a student an entire library's worth of books. It takes massive, flexible computing power. Tier 2 is on-premise. So once the AI model is trained, you don't need the whole library anymore. You bring that smart model in-house to run on your own servers. They call this inference, and it's way more cost-effective for day-to-day stuff. And finally, Tier 3 is the edge. This is the AI running on devices themselves. Your phone, a car, a robot in a factory. These things need to make split-second decisions with basically zero delay or latency. You can't afford to wait to ask the cloud what to do. Building out all three of these tiers is the new arms race. And building this whole three-tier system, wow, it requires an unbelievable industrial effort. We're talking about gigawatt-scale data centers that drink as much power as a small city. We need super advanced liquid-to-chip cooling systems just to keep the chips from literally melting. Huge networks of high-density fiber optics. And maybe the most important parts: access to a stable power grid and just tons and tons of water for cooling. This is the new heavy industry, plain and simple. The thing is, this isn't just about building data centers to rent them out. The ultimate goal here is what's called sovereign AI, controlling your own digital destiny as a matter of national security. And they are putting serious, serious money behind it. Just look at Saudi Arabia's $100 billion Project Transcendence. It's an initiative designed specifically to make the kingdom a global hub for tech and AI. This is a geopolitical power play, not just a financial investment. Now for the final piece of the puzzle. We have a major global investor pivoting from soft power to hard infrastructure. Why should this matter to the average investor or to a venture capitalist in Silicon Valley? Let's zoom out and look at the global shockwave this whole thing is creating. Here's where the rubber meets the road. When sovereign wealth funds, who are, by the way, massive investors in venture capital and private equity, when they start this quiet throttling, it creates what the experts are calling a severe liquidity drought. See, these VC funds rely on the big sovereign investors to meet their capital calls, which is just a fancy way of saying a request for cash to make new investments. When those calls get delayed, or worse, reduced, the entire private market ecosystem just starts to grind to a halt. This liquidity drought is forcing a huge change in how investors are even measured. For the last decade, it was all about IRR, or internal rate of return. That's often just a theoretical, on-paper gain. But now, the new gold standard is DPI, distributed to paid-in capital. The only question that matters today is, how much actual cold, hard cash have you returned to your investors? In a world where cash is tight, your paper profits are pretty much worthless. Cash is king again. And this all brings us to the brutal truth of this entire shift. There's this tendency in some circles to kind of dismiss sovereign wealth as dumb money. But the reality is, when a pool of capital that big decides to leave a sector, the consequences are, well, they're severe. Like the quote says, the floor that was propping up asset prices in that sector, it doesn't just drop. It vanishes. Poof, gone. So we'll end on this question. This pivot from soft power to sovereign AI is redrawing the entire map of global capital. We've seen what it did to sports and utopian real estate. The question you should be asking yourself now is this: with this trillion-dollar fire hose now aimed squarely at hard infrastructure, which vanity sector is next to look down and discover its floor has completely vanished?